Welcome to the channel. I'm the Swedish Dividend Investor. So, today I want to talk about what is on my watch list for the coming months and what I'm planning to buy going forward. If you want to support me, don't forget to like, comment and subscribe. It really helps the algo to push my videos to new viewers. Alright, let's not beat around the bush and dive straight into it. The first on my list is a new ETF. HANetf, Infrastructure Capital Preferred Income ETF. Ticker ASWL or PFFI. It launched late September and it has paid its first dividend in late October. First off, let's talk about the holdings. The holdings consist of preferred shares. You might ask, what the heck is preferred shares? Preferred shares are a type of stock that provides a priority claim on a company's assets and earnings before common stockholders, and they typically pay a fixed dividend. Unlike common stock, preferred shareholders usually have no voting rights. They are considered a hybrid security with features of both stocks and bonds, making them appealing for their stable income but also subjects to risk like interest rate sensitivity and a potential call by the company. So they usually have a date where the issuer can buy them back at a fixed price. In the US, they often get issued at $25 par value, that being the call price they can repurchase them at. So if you buy a preferred stock at $27, you will lose $2 per share if they get called. But if you buy them under $25, say at $23, you get to keep the $2 difference. So usually the preferred stocks are pretty price stable, so you'll miss out on some upside, but get a decent and stable income. The ETF offers monthly dividends and the ETF is domiciled in Ireland, so no withholding tax to the US. The total expense ratio is 0.8%. It is actively managed, which is a good thing, since a passive index would just buy when the underlying goes up and sell when they go down. The managers can buy low and sell high, generating more income and gains. It is managed by HANetf, so this is a mirror ETF of the American ETF PFFA, which he manages as well. Looking at the American ETF PFFA on seekingalpha.com, we can see a nice stable dividend. The pre-pandemic dividend was at 19 cents per month. Then it got cut to 15 cents. And from there we can see growth until today, where the dividend is 17 cents. The performance for 5 years is in the green, but long term it's down quite a bit. However, looking at the total return for the last 5 years, it doesn't look too shabby. Preferred shares are sensitive to interest rates. Higher rates make preferred less attractive and lower rates makes them more attractive. Now, we only have one dividend to go on for PFFI. If we annualize it and buy at around 17 euros, we would be getting a yield of around 8.2%. So I might wait until I can get a 9% yield. Speaking of HANetf, I really hope they can bring a BDC ETF for us European investors, like BXSL or PBDC. It's getting more difficult for us to buy BDCs, and honestly, I would rather own a 10% yielding BDC ETF than to pick my own companies. So I suggest you guys send them an email via their site and ask if they have any plans to launch a BDC ETF. I sent them a request a couple of weeks ago, and I think if enough people contact them, the more likely it is we can get one. Speaking of BDCs, that's the next thing on my watch list. I want to expand my high yield portfolio. I have been eyeing some investments fitting for it. First is Blackstone Secured Lending Fund, BXSL. Like OBDC, they are a pretty new BDC, launched in October of 2021, but the dividend growth has been very good. This could be due to high rates. I won't do a deeper dive into this as for now, but we could check out some stats on seekingalpha.com. So, looking at their dividend history, we can see the first regular dividend was 53 cents per quarter, and since 2023, the dividend is 77 cents per quarter. That's pretty nice. I would like a monthly dividend, but hey, I'm happy if I can get a high yield even if it's quarterly. So, the annual regular dividend is $3.08, and with a share price of around $26, you will get an 11.8% yield. I do like that. Their price performance is down since inception, but looking at their total return since inception, we can see they outperformed the S&P 500 until just recently, when BDCs took a beating. I looked at their latest earnings report from August. I will just give you some quick stats. Over 98% lean investments, and their non-accruals is sitting at an almost non-existing 0.3%. Non-accruals are customers who have been late or having troubles paying the interest during the last 90 days. However, their NII per share, that's their net investment income, is sitting at $0.77 for the quarter. So they just about cover the dividend. So I do think we should discount the dividend a bit, since the risk of a small cut is pretty high. So let's say they cut it to 60 cents per quarter. That's $2.4 annualized, and a pretty big cut. But that's still a 9.2% yield. I think I can live with that. If we buy at $25, it's a 9.6% yield if they cut it to 60 cents. Next contender is Starwood Property Trust. They have been paying dividends since 2009, and they haven't cut it since then. But it has grown from 2014 up until 48 cents per quarter, so that's an annual dividend of $1.92, and with the share price currently being around $18.5, that means it offers a yield of over 10.3%. Pretty sweet. Looking at the share price return, for 10 years, we can see it's negative 8% roughly. But looking at their 5-year total return, we can actually see it was leading the S&P 500 until just recently, so don't sleep on high yielders. This is a hybrid REIT, with both the lending side of a mortgage REIT and they own and manage property as well. Let me know if you want a deep dive into STWD in the comment section down below. Let's go with another ETF, VanEck Morningstar Developed Market Dividend Leaders ETF, VDIV. I recently made a video on this, link in the description, and I liked what I saw. I do want to own this ETF, but I can be patient and invest at the right time. The dividend growth is solid and the yield is okay, but buying it when the market is under pressure could give us a higher yield, which is what I'm aiming for. I said in my video I would want to make this a big position and I would focus on it in 2026. I might do that, but if the bull market continues and high yielders are still attractively valued, I will prioritize the high yield. My aim for next year is to exceed 96,000 Swedish crowns in forward pre-tax dividend income per year at the end of the year. That's about $10,100. So I aim for 8,000 Swedish crowns or around $840 per month on average pre-tax dividend. The last ETF is a big if. It's another HANetf. HANetf, Rex Tech Innovation Income and Growth ETF, FEGI or ASWL, another covered call ETF with the aim to pay out between 12 to 15% income, but only selling covered calls on about 50% of the portfolio to not cap the upside as much. Something that has been a problem with the JP Morgan ETFs and the Global X ETFs. Now for the big if. I will only buy this if we have a serious market correction. I've been thinking a lot about my covered call ETFs during the year. Sure, the income is very nice, but I think a huge crash will drag them down. And if it's a prolonged crash, I think the dividend will be much lower than today. They write call options based on the size or value of the ETF. A bigger value equals more contracts and a higher dividend. If the ETFs crash 50%, they got 50% less to write calls on, meaning the income will shrink. In the short term, this could be offset by the higher volatility, since higher volatility means more option income. But if it's a huge crash and then we stay down with low volatility, That could mean some serious loss of income, but I'm not too worried though, since if the dividend gets slashed, say by 30%, it will still produce meaningful income that could be reinvested. I'm not going to sell my covered call ETFs, but I might trim my position in JP Morgan Global, since I might have gone overboard with it. It's by far my biggest dividend payer, and a 30 to 50% cut in that dividend would be a lot. I am in no rush to do this. It's just something that's been on my mind as of lately. And if I put some of that money into, say, PFFI, I would still get a similar, if not higher dividend, with a bit less risk. Let me know what's on your watch list. Maybe you have your eyes on these investments. As always, don't forget to like, comment and subscribe for more dividend and income investing content. I'm the Swedish Dividend Investor, and I will see you in the next one. Stay smart, stay patient and keep stacking those dividends. Ha det gött!